Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is, if you had one chart, just one chart, besides a regular chart of the S&P 500, as a way to understand the broad market environment, what would it be right now and why? So here is my one chart for today. So today's chart is the S&P 500, and at the bottom we have two key breadth indicators: the percent of stocks in the S&P 500 above their 200-day moving average, and the percent of stocks above their 50-day moving average. Now, I like to look at market breadth. I look at it every day, and there are a couple different metrics that I tend to follow. This one I found really helpful because what it does is it shows you overall participation, right? If the market is doing one thing, these indicators tell you what the masses of stocks are actually doing. Are they agreeing with the overall market conditions, or are they disagreeing? And so the top panel is the S&P 500 with the 50 and 200-day moving averages. The first panel below is the percent of stocks within the S&P 500 that are above their 200-day moving average. At the bottom, it's the percent of stocks above their 50-day moving average, so a little shorter term measurement. In general, the way that I use this is a couple different ways. First off, when you see disagreement or when you see non-confirmation, so when the price is doing one thing and the indicators start to slope downwards or start to do something different. So here in February of 2020, this is one of the indicators that suggested to me we were nearing or in the midst of a topping phase, is when you had the higher highs in price, and indicators like these were all sloping downwards, seeing lower peaks. And that suggested that as the price was going higher of the overall index, it was less and less mega cap stocks, sort of these safety stocks, that were really making that final push higher. A lot of stocks did not, go along with the S&P and make that next final high. Some of them, about 15% or so, had already broken down through some of their key moving averages, and that was a precursor of further downside certainly to happen. So on a short-term basis, you can look at some of these indicators and identify, swings, identify participation. So at the March low in March 23rd, you can see that literally 0% of the S&P 500 remained above their 50-day moving average. All 500 stocks had gone below their 50-day. You can see about 6 to 8 weeks later, almost 100% of the S&P members had gone back above their 50-day moving average. And it speaks to the strength of the V bottom, the strength of price movements coming out of those lows, and really the breadth of that participation. So that's more of a short-term measure, just understanding some of the dynamics and understanding when stocks are really piled into one side of the moving averages or the other, right? When breadth is really strong on one side or the other. But where I think it can be really interesting is more of a longer term measurement, and just thinking about bull and bear phases. If you look back at the last couple of years, you can see that when the percent of stocks above their 200-day moving average, when that measurement remains above 50%, that tends to coincide with bull market phases, which makes sense, right? If the S&P 500 is above its 200-day moving average, if it's making new highs and it's trending upwards, it would make sense that over half of the S&P should be participating in that uptrend, right? Because otherwise, it would be sort of strange, and that's where some problems can occur, is when the S&P is doing one thing, but these indicators are doing something different. You can also see in bear market phases, and again, think of the fourth quarter of 2018 as sort of a short-term tactical bear market, going from the September high down to the low in December of 2018. You can see that the indicator went below 50%. This is right around when the S&P started breaking down through its own 200-day moving average. You can see that most stocks, over half of stocks, a majority of stocks, remain below their 200-day moving average. So remaining below 50% suggested that it was more of a bear market phase. So the last times that's happened, or in 2018, remained positive all through 2019, or most of it. Late February of 2020, it turned back negative, going back below 50%. I think that was one of the key indications here in early March of this year, was that we did not get back above that 50% line. Since then, it remained below. What's happened in the last couple of weeks, though, is we've had a bit of a head fake, perhaps. This indicator has gone back above 50%. That happened the first week in June, suggesting to me this could be sort of the all clear signal. The S&P has gone back above its 200-day. A couple of weeks later, you had this indicator confirm with a breakout above 50%, suggesting more than half of S&P names were above their 200-day. That seems pretty encouraging. Since then, though, the indicator's gone back below 50%, which is actually very unusual. We've not seen that for the last 2 years, and perhaps we'd have to go back a little further to find another example of it, but it's pretty rare. Because usually it crosses the 50% line sort of in a shift of sorts, when everything's sort of in a downtrend and then things start to improve and it rotates back above. But this fluctuation around the 50% line is sort of what the market feels like right now, where there's a bit of indecision. We've had the huge sell-off February to March, the huge rally into the June peak so far from the first week in June. And since then, we're now sort of stabilized, and we're between that peak from a week and a half ago and the low that we established with last Thursday's sell-off into the low that we established Monday of this week. That's sort of the range. So the S&P is sort of stuck in a way between around 3240 on the upside and 2960 on the downside. I think where we go from here will be very, very importantly indicated by which of these levels we break. We either break above previous resistance or down through previous support. If we break down through support, most likely this will be a lower high and then a new lower low, which would confirm a new downtrend. I would then expect this indicator to remain below 50%, or we break out, we continue this upswing, and this becomes a higher low. We break above 3240, maybe 3250, which would confirm a higher high. This indicator most likely will go back above 50%, and that would suggest sort of long and strong in the S&P, most likely returning to previous all-time highs around 3,400. So while the price is always most important to me, looking at breadth measurements like this can be really helpful to understand the dynamics below the hood, sort of opening up the hood and seeing what's happening inside the engine of the markets. And I'm looking very closely at whether or not this indicator goes back above 50%. If you're bullish, if you're expecting further upside, I would certainly be looking for that break above 50% and remaining above 50% as giving fuel to that bullish argument. If you're bearish, I would be looking certainly for it to remain below 50%. If we're unable to eclipse 50% on this short upswing out of last week's lows, I think that could confirm that the weight of the evidence more negative than positive and suggest more retesting, backing, and filling down in the previous price range for the last couple months. So that's my one chart for today. From Market Misbehavior, the whole team here, I want to thank you so much for watching. This is Dave Keller. Take care.